Hey everyone, and welcome back. I am so incredibly pumped to have you here for another explainer. Today, we are tackling one of the single most popular yet heavily debated retirement investing options out there, target date funds. If you've got a 401k or any kind of workplace retirement account, you've definitely seen these. I mean, they're literally everywhere. But today, we're going to slice right through the standard marketing pitch and get to the honest truth about how these things actually operate. So, let me ask you a question. Do you want a completely hands-off way to invest for retirement? That right there is the ultimate dream, isn't it? Target date funds are relentlessly marketed to us as this absolute, flawless, set it and forget it solution. The promise is amazing. You don't have to stress, you don't have to spend hours doing research, and you definitely don't have to obsessively watch the stock market. But, as focused learners, we've got to ask the tough questions. Is that promise actually true? Are they really worth your hard-earned cash, or is there some kind of catch hiding in the fine print? Well, let's find out. Okay, moving into section Under the Hood, how target date funds actually work. To really grasp how picking a single fund with a year on it, like 2045 or 2055, works, you absolutely have to understand a concept called the glide path. So a glide path is basically this automatic process where the fund shifts your investments from aggressive stocks over to conservative bonds and cash as you get older. Think of it as the built-in engine of the whole fund. Once you pick the year closest to your actual retirement and put your money in, the fund takes the wheel. It entirely handles the diversification, the continuous rebalancing, and adjusting your risk level so you literally never have to lift a finger. Let's look at what that glide path looks like in the real world when you're just starting out. Picture this. You're a young investor, decades away from clocking out for good. You pick a target year way out in the future. At this point, your fund's allocation is going to be super aggressive, heavily focused on chasing maximum growth. We're talking something like 85% in stocks, maybe 10% in bonds, and just a tiny sliver like 5% in cash. And that makes total sense, right? Because you have plenty of time to ride out the roller coaster of the stock market, the fund goes all in on aggressive growth. But fast forward a bit. As that target retirement year gets closer and closer, your timeline shrinks. Suddenly, capital preservation is the name of the game. Without you doing absolutely anything, that exact same fund automatically shifts into a much more conservative, protective mix. Your stocks might drop down to, say, 40%. Bonds take over the heavy lifting at 50%, and your cash cushion bumps up to 10%. The fund is quite literally gliding you in for a safe landing, sheltering your savings right as you're getting ready to actually spend them. Which brings us to our next section, the trade-offs, weighing at the pros and cons. Because, hey, nothing in finance is perfect, right? We have to take a really objective look at what you're actually giving up in exchange for all that amazing convenience. Look, the benefits are totally undeniable. You're managing just one single fund instead of a dozen. You get instant, automatic diversification across thousands of stocks and bonds, and you never have to rebalance it yourself. It's a lifesaver for beginners or just really busy people. But yes, there is a catch. The downsides? You're going to get hit with higher fees. The entire structure is completely one-size-fits-all, meaning it totally ignores your personal risk tolerance. And a huge one, different funds actually have completely different glide paths. Actually, let's pause and talk about those expense ratios for a second because this is crucial. You're typically going to see fees ranging anywhere from 0.08% up to 0.5% or even higher. Now, I know what you're thinking. A fraction of a percent sounds like absolutely nothing, but you have to compare that to plain DIY index funds, which can have fees sitting at pretty much zero. Over 20, 30, or 40 years, the magic of compounding actually works against you here. That tiny little percentage can silently drain tens of thousands of dollars from your portfolio over the decades. Make no mistake, you are absolutely paying a premium for the luxury of that glide path.
Okay, here is a massive pro tip that you absolutely need to take away from this explainer today. Not all glide paths are created equal. You have to check whether your specific fund manages your money to retirement or through retirement. It's a huge distinction. A to fund gets to its most conservative bond-heavy mix exactly on your retirement year. Boom, done. But a through fund, that one assumes you're going to keep your money invested during your retirement years, so it actually stays a bit more aggressive with stocks right on through your retirement date. Knowing exactly which one you hold is just vital to understanding how much risk you're actually taking on when you finally quit working.
Let's move into our final section, your best path forward, who it's for, and alternatives to consider. So we've seen the mechanics, we know the trade-offs. Who is this actually for? Well, a target date fund makes the most sense for you if you check 3 specific boxes. 1, you want minimal effort. 2, you are investing mainly for retirement. And 3, you just really do not enjoy managing your own portfolio. If sitting down on a Saturday to analyze stocks and rebalance your asset allocation sounds like absolute torture to you, then the sheer value of the minimal effort a target date fund provides really can't be overstated. But what if you're someone who actually wants a little more control over your money, or maybe you just want to completely dodge those higher fees we talked about? There are some fantastic alternatives. First off, you could easily build a simple 3-fund portfolio yourself. You just grab a total stock index fund, a total international index fund, and a total bond index fund. You completely control the ratios, and you get those rock-bottom fees. Another really cool alternative is looking into robo-advisors. These are automated platforms that manage the whole shebang for you, often with way lower fees than traditional target date mutual funds, and they can even give you a more customized glide path based on a quick financial quiz you take. So, what's the final verdict here? Ultimately, for most people, and especially for beginners, a low-cost target date fund is just an excellent choice. It is infinitely better than getting overwhelmed and doing nothing at all, and it totally removes that dangerous temptation we all get to try and time the stock market. Sure, they really are set it and forget it, but I'll add one tiny caveat to that. Just review it once a year. Honestly, just a quick 5-minute annual check to make sure the fees are still competitive and that the fund's glide path is still vibing with your actual life plans. And that brings us to the end of our explainer. I really want to leave you with a question to chew on today. Are you team autopilot? Do you prefer the convenience of a target date fund, happily paying just a little bit extra for that total peace of mind? Or, now that you're armed with this knowledge, are you ready to take the wheel, dodge those higher fees, and start building your own portfolio? Remember, there is absolutely no wrong answer here, as long as you are actively planning for your future. Figure out what fits your personal style, double-check those expense ratios, and go make your retirement a whole lot easier. Thanks so much for hanging out with me for this explainer, and I will see you next time.